Let me ask you something right off the bat. When you think about your IRA, what comes to mind? Stocks, bonds, mutual funds, maybe some CDs or target date funds. That's what 99% of people think about when they hear IRA. And it makes sense because that's what traditional brokerage financial institutions want you to think. That's what they offer. That's what they're set up to handle. But here's what most people don't know. Your IRA doesn't have to work that way. Welcome to this deep dive on using self-directed IRAs for private lending. I'm going to walk you through exactly what this means, how it works, what the rules are, and whether this approach might fit your retirement strategy. Let's start with the foundation. A self-directed IRA is a retirement account that gives you control over a much broader range of options than traditional brokerage IRAs. The account structure is the same. The tax advantages are the same. Traditional self-directed IRAs are tax deferred. Roth self-directed IRAs offer free tax growth once you meet the requirements. The difference is what you can direct your IRA to hold beyond stocks and bonds. A self-directed IRA can hold alternative investments like real estate, promissory notes, private placements, private stock, precious metals, cryptocurrency, and many, many more. Today, we're focusing specifically on promissory notes, what most people call private lending. So, what does private lending through your IRA actually mean? It means that your self-directed IRA becomes the lender in a debt transaction, not you personally, your retirement account. Here's how it works in practice. Someone needs capital. Maybe they're purchasing real estate, but traditional financing doesn't work for their timeline. Maybe they're expanding a business and need equipment financing. Maybe they're a real estate developer who needs bridge financing for a project. Maybe it's even someone who needs a loan for a new car. You identify the opportunity, you evaluate the borrower, you assess the terms they're offering, you look at any collateral securing the loan. If everything checks out based on your due diligence, you direct your IRA custodian to fund the promissory note from your self-directed IRA. Now your IRA holds the promissory note. The borrower makes the payments according to the agreed schedule. Those payments, both principal and interest, go directly back into your self-directed IRA. This is fundamentally different from your IRA owning stock in a lending company. When your IRA holds private lending notes directly, you control which borrowers to work with. You decide what terms are acceptable, and you make decisions about each property. Now, here's where we need to talk about the rules. Because the IRS has very specific guidelines about how retirement accounts can operate. These aren't suggestions. These are requirements, and violating them has serious consequences. Immediate taxation of your entire IRA balance, plus potential penalties. The prohibited transaction rules exist to prevent self-dealing. Your IRA exists for your future retirement benefit, not for current personal advantage. So, your self-directed IRA cannot lend to you, your spouse, your children or grandchildren, your parents or grandparents, spouses of your descendants or ascendants, any businesses these people own 50% or more of, or any entity where you serve as an officer or a director. That means you cannot use your IRA to lend to your own business, buy property from a parent, finance your child's business expansion, or lend to your spouse on a real estate deal. Even if the terms are completely fair, even if you're charging market rate interest, even if everyone involved benefits, it's prohibited, period. The arm's length transaction requirement means all your IRA transactions must occur at fair market value with commercially reasonable terms. You can't give your friend a sweetheart deal. You can't accept terms you wouldn't accept from a stranger. Now, let's talk about due diligence because this is critical. Mountain West IRA, like all self-directed IRA administrators, provides account administration. We don't evaluate opportunities, we don't assess borrowers, and we don't recommend whether you should proceed with any transaction. That's your job. Before you direct your IRA to fund any promissory note, you need to understand a very few important things. Can this borrower actually repay? What's their credit history? What's their income or cash flow? If they're a business, what are their financials? What's the collateral worth? If it's real estate, what's the current market value? What condition is the property in? Are there any liens already against it? What are the market conditions? Is the local real estate market strong or declining? Is the industry the borrower operates stable? What happens if things go wrong? If the borrower defaults, what are your options? Can your IRA foreclose? And what would that process cost? How long would it take? All of these questions aren't questions to answer after you've already funded the loan. This is research you need to do upfront. Many successful IRA private lenders work with professional advisors, attorneys who can draft proper documentation and advise on state law compliance, CPAs who can handle tax questions, real estate professionals who can evaluate property values. This isn't because they can't think for themselves. It's because they recognize that expertise matters. Documentation matters. And protecting their retirement account absolutely matters. Speaking of documentation, this is non-negotiable. Every promissory note needs proper documentation with correct IRA titling. This means the promissory note itself, detailing the loan amount, interest rate, payment schedule, maturity date, and all terms. This includes a security agreement if collateral is involved, establishing your IRA's security interest, a mortgage or deed of trust for real estate loans, creating a lien against the property, a UCC-1 financing statement for loans secured by personal property or business assets. And here's the critical part. All documents must title your IRA correctly. The lender is your IRA, not you personally. To give you an example of the proper vesting, if John Smith is using his IRA to lend, the proper title would be Mountain West IRA, FBO, John Smith, IRA, account number 123456. Many IRA holders work with attorneys experienced in private lending to prepare these documents. The cost of proper documentation is an investment in protecting your retirement account. Let's talk about what happens when a borrower makes payments. All payments go directly to your IRA custodian or administrator, not to you. The administrator deposits them directly into your self-directed IRA. Principal and interest payments increase your IRA balance available for other opportunities. In a traditional self-directed IRA, these funds grow tax-deferred until you take distributions in retirement. Then they're taxed as ordinary income at your rate at that time. In a Roth self-directed IRA, if you meet the age and holding period requirements, all of this growth can be completely tax-free when you take distributions. This is the same tax treatment whether your IRA holds promissory notes, stocks, real estate, or any other asset. The tax advantage comes from the IRA structure itself. Now, what if a borrower defaults? This is where having secured loans versus unsecured loans makes a huge difference. If your IRA holds a secured note and the borrower defaults, your IRA has the rights to the collateral. For real estate, that means your IRA can initiate foreclosure. For personal property, your IRA can repossess. All costs associated with foreclosure, legal fees, filing costs, property preservation, must be paid from IRA funds. You can't use personal money to cover IRA expenses. If your IRA acquires property through foreclosure, that property is titled in the name of your IRA. Any rental income from the property goes to your IRA. All expenses, such as property taxes, insurance, maintenance, all are paid from IRA funds because remember, the IRA is the owner of that property, not you. When your IRA eventually sells the property, all proceeds are returned to your retirement account. For unsecured notes, if the borrower defaults, your IRA's options are more limited. You can pursue legal collection, but there's no specific collateral to reclaim. Recovery depends on other assets the borrower has. This raises an important question. What can't you do with IRA private lending? You cannot personally guarantee loans your IRA makes. The IRA stands alone. If the borrower defaults, your IRA deals with the consequences. You can't bail it out with personal funds. You can't live in property your IRA acquires through foreclosure. You cannot use equipment or vehicles or anything else your IRA repossesses. The IRA's assets must remain separate from your personal use. Let's talk about common lending scenarios people pursue with self-directed IRAs. Real estate lending is probably the most common. Your IRA provides the financing for someone to purchase property. The property serves as collateral. Terms might be interest only for a period, then a balloon payment at the end, or it might be fully amortizing over time. You and the borrower negotiate the terms that work for both parties. Business lending is another popular option. An entrepreneur needs capital for inventory, equipment, or expansion. Your IRA provides a loan with agreed terms. Sometimes these are secured by business assets. Sometimes they're unsecured based on the business owner's creditworthiness. Some IRA holders participate in peer-to-peer lending platforms that accommodate self-directed IRAs. Others work directly with borrowers through professional networks. The key is that your IRA is always the lender on the documentation. Before we wrap up, let's talk about whether this approach might fit your situation. Private lending through a self-directed IRA might make sense if you have knowledge in an area where lending opportunities exist. Maybe this would be real estate, maybe business operations, maybe a specific industry. You're comfortable evaluating borrowers and assessing risks. This isn't passive income like dividend from stocks. You're making lending decisions. You understand and follow prohibited transaction rules. No lending to family, no self-dealing, period. You're willing to work with professionals, attorneys, CPAs, others, to ensure proper structure and documentation. If you want control over your retirement account options, rather than following what Wall Street recommends. If those factors describe you, private lending in a self-directed IRA might be worth exploring. Mountain West IRA provides self-directed IRA administration and education. We can help you set up an account, process transactions you direct, and provide resources about how self-directed IRAs work. What we don't do is provide financial advice, recommend specific opportunities, or evaluate lending deals. That's your responsibility, or the responsibility of advisors you choose to work with. You can learn more at mountainwestira.com. We have educational resources about self-directed IRAs, contribution limits, prohibited transactions, and the processes for directing your IRA to hold alternative assets like promissory notes. Here's the bottom line. Private lending through a self-directed IRA is one option for diversifying your retirement account beyond stocks and bonds. It gives you control to make decisions in areas where you have expertise. It requires you to understand rules, perform due diligence, and properly document transactions. If you're looking for complete control over your retirement options and you're willing to do the work to evaluate lending opportunities properly, this might be an approach worth considering. If this information was helpful, share it with someone who might benefit from learning about self-directed IRA options. If you want to learn more, we have plenty of education on our website. Be sure to like and subscribe so you don't miss any of our videos. Thanks for watching and have a great day.